Today we're breaking down Marathon Petroleum's third quarter 2025 earnings call, and there's a lot to unpack here. From impressive cash generation to some interesting margin dynamics, MPC is navigating a complex refining landscape. If you're invested in energy stocks or just want to understand where the refining market is headed, you'll want to stick around because we're counting down the top 10 takeaways that could impact your portfolio. Let's dive in. Coming in at number 10, we have exciting developments on the West Coast. With refinery closures happening in California, MPC is seeing cracks hit $40 per barrel. That's seasonally strong and represents tremendous margin opportunities. The company is also benefiting from wider ANS differentials as TMX barrels enter the market, reducing demand for Alaskan crude. Their integrated system across Los Angeles and Acordes and Kenai positions them to capture these dislocations better than competitors. At number 9, let's talk about renewable diesel. The Martinez facility is facing headwinds with regulatory uncertainty around foreign feedstock limitations and D4RIN values remaining depressed. Management made it clear they're only investing in reliability at this point, not growth. The segment is a very small part of the portfolio, and they're focused on running efficiently while waiting for regulatory clarity in 2026. Number 8 brings us capital expenditure guidance. This is important for investors. MPC expects 2026 capital spending to come in below 2025 levels. They've been finding good investment opportunities in reliability and margin improvement projects, particularly in the midstream Permian Basin, but they're being disciplined about deployment. This should support free cash flow generation going forward. At number 7, we need to discuss the mid-cycle margin outlook. Management is bullish on fundamentals heading into 2026. They're seeing tight supply conditions with inventory levels below 5-year averages for both gasoline and distillate. Modest growth in diesel and jet demand, combined with flat gasoline consumption, points to a healthy market that should support elevated margins through the cycle. Number 6 focuses on crude slate advantages. MPC is seeing ASCI prices about $2 weaker than earlier in the year, and they have significant barrel exposure priced against this benchmark. They're also increasing Canadian heavy crude runs, particularly at Galveston Bay and Garyville, taking advantage of wider differentials. This feedstock flexibility is a real competitive advantage for their Gulf Coast system. Coming in at number 5 is the MPLX growth engine. The midstream subsidiary increased its distribution to 12.5% this quarter and is targeting that growth rate for the next couple of years. This brings MPC's annual distributions to $2.8 billion, heading toward $3.5 billion. The Permian natural gas and NGL investments, including the recent sour gas treating acquisition, are driving this durable growth profile. At number 4, we have turnaround impacts to discuss. Fourth quarter turnaround spending is projected at $420 million, with major work focused on the West Coast. The big news is the completion of their multi-year Los Angeles refinery infrastructure project, which should strengthen competitiveness and improve EBITDA starting in 2026. Management expects turnaround costs to decline in 2026 and beyond. Number 3 brings us to capture rate volatility. Third quarter capture came in at 96%, down from 105% in the second quarter. The main driver was West Coast clean product margins falling 40%, plus jet-to-diesel differentials that compressed dramatically and even went negative. Management called this unprecedented volatility, but emphasized it was market-driven and has already normalized in October. Year-to-date capture of 102% demonstrates their sustainable commercial improvements. At number 2, let's talk about cash generation power. MPC delivered $6 billion in operating cash flow year-to-date and returned $3.2 billion to shareholders. That 102% capture rate demonstrates the commercial excellence they've been building over several years. Strong operational execution with 95% utilization, even during planned turnarounds, shows the team can deliver in varying market conditions. This cash generation ability is foundational to everything else they're doing. And our number 1 takeaway, the dividend increase and capital return strategy. MPC announced a 10% dividend increase, marking 3 consecutive years of 10% raises. Management confirmed they're comfortable maintaining this trajectory for several years, supported by growing MPLX distributions and declining share count from buybacks. Share repurchases remain the primary capital return mechanism, and they're committed to leading the peer group in total capital returns. With over 50% of equity retired through buybacks in recent years, this strategy is creating significant per-share value. That wraps up our countdown of Marathon Petroleum's third quarter earnings. If you found this analysis helpful, make sure to like this video and subscribe for more earnings breakdowns. Drop a comment below telling me which energy stock you'd like me to cover next.